As a day trader, most of the time you are always on your daily time frame and you are always working with this your daily time frame candles, because this your daily time frame candles gives you the direction of the market. But the areas where I see most traders find difficult is the entry, because many traders struggle with entry pattern in the market, entry confirmation, because it's not just enough to just know the direction of the market. You have to know the right time to engage the market. And so many people approach it wrongly because they have been used to, some certain patterns in the market, like some of all these entry patterns, like supply and demand pattern in the market, or those of you that use your entry models with liquidity sweep, as your entry model. If you are a day trader that work with entry patterns like this is what we call static entry patterns. It will be very, very difficult for you guys to see entries in the market unless you don't trade only one particular instrument, unless you go from pairs to pairs scanning for the entry pattern in the market on a particular instrument you want to trade. But if you focus majorly on one instrument in the market, like personally, I focus on Euro USD, GBP USD. Trading some of all these patterns will be difficult because you're not going to see it every day in the week. So what we do as day traders, we make use of dynamic entry approach, which you guys are going to learn from this video today. Because if you check this image I have right here, majorly this is the pattern you are going to see in the market on your daily time frame candle. So this is day time frame candle. Majorly, this is what you are going to see in the market. After the first day has closed, the second day will come with a minor retracement and then expand to the upside. It is very difficult for the first day to close and then the second day will retrace all the way to this demand zone in the market. Before, that's why I said if you work with all this pattern in the market as your entry pattern, it will be difficult for you guys to see entries on daily basis. Let's take a look at some of these candles here on the chart. Let's take a look at these bearish moves, for example. If you take a look at these candles very well, it will be very difficult for you to make use of supply demand trading strategy. Mainly looking at this on this higher time frame, it will be difficult for you to use liquidity entry strategy. For example, this day the market opened, drop to the downside. This day the market opened, just a minor move to the upside and then drop to the downside. This one, there was no retracement at all and then drop to the downside. This one, no retracement, the market dropped to the downside. So this video, I'll be teaching you guys one of the best entry model in the market that you can see every day, repeatedly every day, as long as this market exists. So it depends majorly on this daily candlestick, all right? So once the first day closed, the second day, you are going to see this pattern in the market. And if you take a look at what I have here on this my right-hand side, you'll see I purposely draw this pattern like this because some people, they just want the market to come to below 50% of Fibonacci before they start looking for entry, either at fair value gap or any other block on this range. But it doesn't actually have to be like that in the market because there are some days the market doesn't go below 50% of your Fibonacci range and then it start moving to the upside. So you have to be dynamic. That's why I classified all these entry patterns in the market as static approach. So all the static approach, they are majorly for traders who go from pairs to pairs in the market, from asset class to the other, scanning for the setup in the market. But you that want to focus on a particular instrument, let's say Euro USD, GBP USD, SA USD, NAS 100, just one particular instrument, discipline to one particular instrument, you have to learn how to be dynamic because every day the market will give you dynamic approach. And dynamic entry model is based majorly on time of the market. That's why we call it time and price theory, because we are working with time and also price of the market. This is the price levels. At this right-hand side, all these numbers you see here are the price levels. Then the time of the market depends on the session of the market. But we are not making use of the whole session of the market. We are making use of just the first 3 or 4 hours of each session in the market. For example, the first 3 hours of London session, the first 3 hours of New York session. And that is why you guys always see this shaded area on my chart every day. And the most exciting part of it is that there is no day that you are not going to see this shaded area. This shaded area actually shows the first 3 hours of each of these sessions. London session, New York session, London session, New York session, London session. Like as I said, every day you will always see this session in the market. So it's like everyday model. So you can't compare it with the static approach because static approach, you may necessarily not see the pattern every day in the market, but every day you will always see the session time in the market. The only problem is that so many traders don't know how to respond to what price is giving them in this time of the market. That's why I'm here to help you guys. So what we need is the time of the market. Let's make use of this particular day. This is Wednesday, 9th of April, 2025. So let's use this day, for example. Now, if you take a look at this day, of course, it was a bullish day. So the market expanded to the upside and the move started during the London session. And then remember I told you guys the first 3 hours of the London session and then continue during the New York session. So these two areas are the areas we want to work with. Okay. If you take a look at these two sessions of the market, you observe that the move started at this point. This is the origin of the move, and then this is the continuation of the move. So what we do as traders is read the first move during the London session, and it is usually one direction, either bullish or bearish. For example, this day the move was bullish, so the move started. The first impulse move during the London session is going to give you what the direction of the day is going to be most of the time, from 80 to 90% of each of these trading days. So what you do is read the direction of the move from this London key zone. Let's say if you need this indicator I'm using to identify all the session, this is indicator right here. So click on indicators, and then you're going to see it, my favorite indicator, KZ bosses. You can type it here, ICT KZ bosses, and then all the shaded area will pop up on your screen. So we are going to read it from the first move. So if you take a look at this complete day, the move started from here. It is easy to see that this move was bullish because obviously the origin of the move was here, and then this is the end of the move. Now, what we do is we wait for New York session, because each of these days is a combination of two sessions, London and New York session. These are the two sessions that makes up each trading day. So what we do, we first of all read what London session have done for us. If London session says bullish, chances are the rest of the day is going to be bullish. All we just need is pick up our Fibonacci retracement to get the best entry in the market, and then bring it up to this level, to the end of the move. Then we wait for the New York session. As we are waiting for New York session, we have to be very, very careful to make sure that price doesn't go below this origin of the move, which is the low of the day. So now price doesn't go below this origin of the move, then we can catch this move from New York session. And this is one of the best entry model I've traded with as a trader in this industry. So I just have to wait for the first 3 hours of New York session. Remember, this two session is still London session because this is just 3 hours. So this 3 hours is also part of London session, but at this point it's completion of both London and New York session. So I just have to wait for price to go below this 50% retracement, and then probably trade to either other block or fair value gap, which is one of these levels you guys are seeing right here. This is the fair value gap that price make use of, and then our entry is at this spot. This model works almost every day. Let's take a look at another trading day, which was yesterday, Thursday. All we just have to do is let us read the direction of the market that London key zone gave to us. And most of the time, it's going to be either bullish or bearish. Most of the time, it's not going to be consolidating. So that's why I said it's either bullish or bearish. Now, at this point, we have to read it, and this is the direction of the market that London session gave to us. So what we just need to do is place Fibonacci retracement at this spot, and then wait for the market to go just slightly above it. And chances are sometimes we don't really make use of Fibonacci, because once London key zone has given us the direction of the day, most of the time that's what New York session is going to be. So if the market doesn't go above the 50% of Fibonacci retracement, you can still make use of your entry during this New York session. And that's why yesterday became bearish for the rest of the day. The same thing is what is going on right here on this trading day. So what I just need to do at this spot is identify my key zone moment, the price action from my London key zone, which is this high to this low. And then I just draw my Fibonacci retracement, wait for my New York key zone, which is about to start in the next 1 hour. Yeah, which is about to start in the next 1 hour or 2 hours. Then all I just need is let the market not go above this high here, because if price go above this high, then we cannot get our entry anymore during the New York key zone. So we just wait for the session to start, the New York key zone to start, and then we are looking for our entry, either any of this other block or fair value gap at this spot. That is where we should be looking for our entry at this point of the market. So I just have to place my short position here, and then I'm waiting for the market to get to this spot. And let me see what New York session is going to give to us. But remember the rule, make sure it doesn't go above the high of London key zone. So we are waiting for price to get to this spot during the New York key zone, and then we just smash our trade. And then we can use our higher time frame for our target in the market. So one of the advantage of making use of this dynamic approach is that you will be seeing these entry models every day. For example, all these sessions will be coming up in the market every day. London, New York, London, New York, London, New York, London, New York, every day in the market. London, New York, London, New York. So all you just have to do is learn how to approach it in the market. For example, this day was a nice trading day. If you take a look at it, this is the direction of the London key zone. The market came back as a form of retracement to trade into the New York key zone and then smash on the upside. But at this point, there was a reversal in the market. Of course, that is normal as a trader. So if you take a look at the previous day as well, you will see that the same pattern, the same approach, where is the direction of the London key zone, which is this value one right here. The market traded to the upside, So what we just need to do is draw a Fibonacci retracement, wait for price to retrace back into the range, or make use of this very high here, wait for price to trade back into the range, and then we smash it to the upside. This pattern is what you can make use of as a day trader if you work with only one instrument in the market. Instead of using all the supply, demand, support and resistance, liquidity sweep, total soup, going from one pair to the other, you can just focus on one, making use of this time of the market from London to New York, from New York to London. This is how to be dynamic as a day trader. If you work with this approach, you'll be seeing your entries every day in the market, every day in the market. All you just need to do is wait for one session to be over, and then you engage on the other session. So I believe this video has been insightful and be helpful to most of you guys that are new here. If you are new here, make sure you subscribe to this channel, turn on the notification button on. I'll see you guys next upload. Peace.